Well, you mentioned, I think there were many announcements being made on SmartCon, and one of them is UBS, but all those other institutions actually using CRE, and we could touch upon CRE in a little bit. Are we getting into a stage of, if we have from 0 to 1, we are somewhere in the middle, and from a game theoretical perspective, in a few years from now, you're actually behind by not using any on-chain protocol? Is that how institutions are looking at it at this point as well? Like, we have to do anything to be, as we can see how good this technology is and how more efficient it can be, we have to use the actual instrument that Chainlink is providing or any of the other ecosystems are doing?
So there's different categories of traditional finance that are in different stages of adopting this technology. Oracle networks, CRE, blockchains, and so on. There are really two driving forces. One force is the market dynamics that generate demand for whatever is tokenized. So what is the demand for a tokenized equity? What is the demand for a tokenized fund? What is the market demand for this thing? If I tokenize something, is there a market? Am I going to be able to sell it? Is there a reason for me to engage in this process of generating on-chain versions of assets, right? The second thing is the efficiency benefits. So the efficiency benefits are things like 24/7, 365 markets, 24/7, 365 collateral management. In traditional markets, the weekend is the weekend. There's no markets.
Yeah.
And collateral management isn't even as good as that. Collateral management happens on a schedule of 21/5. So 21 hours, 5 days a week, which is a bit insane, frankly. At the end of the day, the efficiency, I think, will be a huge attracting force. But I don't think you'll be able to prove the efficiency until there's enough assets on chain that those assets begin interacting with each other and with stable coins to generate markets. So the key thing that I think has been missing, like let's say 3-4 years ago, was that institutions saw that there was enough of a market to generate tokenized things themselves. Now with the stablecoin legislation, there's a big boom in stablecoins and tokenized deposits. And that creates a market that can buy your tokenized asset, basically. So if the market of stablecoin purchasing power was 100 billion before, it's hundreds of billions now. And it's going to be trillions. That's a big market. And the second thing that happened to encourage tokenized assets to go on chain from institutions is even though the stablecoin kind of bill from the US in the US, the Genius Act, doesn't have anything to do with the tokenization of other assets. It's a very clear signal that legislation like this can be passed very quickly.
Yeah.
And so and now there's a lot of work on market structure, which is the second big bill, and is the bill that actually relates to the tokenization of assets.
The Clarity Act.
Well, Clarity is the name of it from the House. What it's going to be called in general, I don't know. They'll still figure that out. But at the end of the day, I think once you have assets on chain and people see the power of blockchain technology to create these 24/7, 365 markets, collateral management capabilities, once you compare that with the way things work in the traditional world, I really haven't met anybody that understands that comparison and says, no, you know what? I think I'd like the traditional way. The problem is really people don't understand. They don't understand the difference. And there's been a historic kind of negativity about blockchains and cryptocurrencies that has skewed the mindset of the traditional finance industry towards, all this blockchain stuff is about illicit finance. It's about money laundering. It's about drug dealers. It's about all this random crazy shit. And, now with the government, the U.S. government saying, no, we're gonna support this thing. We want this thing. It's very clear to everybody that A, this is going to happen. B, this thing is safe and actually positive. So that's what I think is going to happen next. Is the market demand is then going to create initial adoption tokenized assets, and all the related systems that need to power it, like the oracles, Chainlink runtime environment, bridges, data, all this stuff. But then once those initial markets are created, the people in the traditional financial system will look at how those markets and how those assets work, and they'll be like, my God, this is 10 times better. So I do think the efficiency will eventually be a big attracting force. But I don't think they'll believe it until the assets exist to create the markets. Does that make sense?
Yeah. But in that point, if the assets exist, I think Web3 has been trying to tokenize everything from the inside out. So we had like, prediction markets, for instance, is a new market. We try to make a prediction market out of everything, but then there's not enough liquidity. And that brings up like the question of, do we have enough liquidity to make markets out of everything? Well, for sure, a few years ago we didn't. And now by the fact that we are having real world assets like tokenized market funds or bonds or equities that are going on chain, is that shift taking place of there is a market that will drive the liquidity instead of the other way around that we used to know?
I think the liquidity from the Web3 and the crypto side of the equation is something that has definitely helped institutions decide to do some early tokenization. But when you say that the Web3 folks have been trying to do real-world asset tokenization for a while, I think the problem there is that that's not really their expertise.
Mm-hmm.
Their expertise is in creating DeFi systems and markets. To clarify what I mean, if you look at the most successful real-world asset other than stablecoins, it's BlackRock's BUIDL. Why is that? Well, BlackRock is really good at real-world, financial things. And so they made this kind of on-chain treasury.
Mm-hmm.
And then it became very popular in a way that, previous attempts to tokenize funds and treasuries weren't popular. So I think you're going to see a good amount of that. I think you're going to see a good amount of traditional financial institutions that finally get it together and start doing more tokenization of the stuff that they already deal with. So instead of the Web3 person figuring out how to build a bank, the bank is going to figure out how to put stuff on chain.
Yeah.
Right? Which of those two is going to be easier? Well, it depends on who the Web3 person is. It depends on the bank. But I think a lot of the high quality stuff will come from institutions just because that's their business.
Mm-hmm.
And putting it on chain is getting cheaper and easier. And we're enabling that with CRE and a lot of other technologies. In terms of the liquidity, I think there's really two worlds of liquidity. One world is the crypto, public chain, degen, DAO treasury world of liquidity, right? So it's the liquidity in the public chains in whatever form, retail, hedge funds, DAO treasuries, whatever. And DAO treasuries were a very big purchaser of the BlackRock BUIDL fund, I think the largest category by far. So, that market has now grown large enough that it in itself as a market is attractive enough, which is great, which we should all be very happy about. And it's a consequence of all this excitement and speculative activity making those DAO treasuries big, which I'm fine with. That's great. People have capital to do innovative things. Some of them will work, some of them won't work. Welcome to capitalism. So it's totally fine. The other category of liquidity is the institutional liquidity, which so far has only touched our industry through ETFs. That is actually the liquidity that I am very interested in. So I believe that the liquidity of the retail crypto user, DeFi degen, prop trading hedge fund that wants exposure to crypto, that wants to get 8% on the US dollar and, in Aave instead of 4% via some treasury holdings. I think that's a big group. And, I can see that group growing from 3 or 4 trillion to 7, 8, maybe 9, 10 trillion. I can see it. Absolutely. But the liquidity we're talking about in the institutional world is all the money in the world. We're talking about the pension funds. We're talking about sovereign wealth funds from the Middle East. We're talking about really conservative, very wealthy people, family offices. We're talking about all the money in the world. We're talking about hundreds of trillions of dollars. So the real question here is, in my opinion, how do you unlock the hundreds of trillions of dollars in the traditional system to flow into our industry? You should absolutely continue to grow, from 3 to 4 to 5 to 7 to 8 to 9 to 10 in the organic growth of our industry.
Mm-hmm.
That's good. That should happen. And making DeFi reliable, the way Chainlink does with data and bridges and all this stuff is an important part of that. Enabling DeFi to grow, enabling more exciting use cases to happen in public chains, something we've always all been excited about when we work on Chainlink and with all our users. But at the end of the day, the numbers just, in my opinion, are not going to add up. I think with the organic growth, you get to a certain point, and if you want to go beyond that point, you need the institutional capital. And the only way you're going to get the institutional capital is if you make the DeFi world and the crypto world and the tokenization world what they want.
Mm-hmm.
You have to make it work in the way that they are allowed to deal with it. You have to enable them to take custody of things the way they need to. You have to enable their existing trading systems and messaging systems to interact with all these tokenized assets. I think that accelerating their ability to use all this and go on chain is really kind of the core idea of a lot of our work with these institutions. Even, for example, our work with JP Morgan, we connected their private payments chain that has JP Morgan clients on it, which is, JP Morgan, I think, in total has 4 trillion assets under management. So it's not bad.
They're building a tower here.
They've built it, yeah. They have a big tower, that's right. And then we connected that to a public chain called Ondo. So Ondo is public chain. So now the clients of this private chain from the institutional world can use a public chain's tokenized fund, money market fund from Ondo. So it's this type of stuff that I think is a sign of the future.